Hello everybody, this is Professor Lambert on business valuation of privately held companies. This is lesson number 5. There are 3 main approaches to determining the value of a privately held business: the income, the market, and the asset approaches. And we're going to discuss each one of these in turn. The income approaches consist of 2 different approaches: a discounted cash flow method and what's called a Gordon growth model or dividend discount model. The discounted cash flow method is something that many of us are familiar with from finance classes or other classes we've taken in college. What the discounted cash flow does is it looks at a company's projections of their expected future performance. This is usually starts with a projected income statement for the next few years until the company reaches a steady state of growth. And for most companies, this ends up being a 5-year projection. There's nothing magical about 5 years. Sometimes the company will not reach steady state growth until longer than 5 years, but in practice, most people will provide projections for 5 years. These future income streams are converted to a cash flow, either to cash flow to equity or cash flow to all invested capital, and we'll discuss what that means in a little more detail. And then those cash flows are discounted back to the present value using a discount rate or a cost of capital. Now, a discount rate just means what interest rate do we require to invest in this asset. It's the same thing as the cost of capital. What is the cost of debt capital and what is the cost of equity capital? And just a quick reminder, capital is just another phrase to mean money. And companies can get money in 2 different ways. They can borrow it from lenders like bond holders or banks, and that's called debt capital. Or they can sell their shares of their stock, usually common stock, but not always. Sometimes preferred stock is also sold, and that would be equity capital. You're selling an ownership stake in common or preferred stock in your company. And investors who are looking at their risk-reward curve want to have a cost of capital or a discount rate that matches the risk they're taking to invest in that company. So many of you, again, may have done that. We're going to also do this in a very practical way for our company in our case study. The Gordon growth model, or sometimes this is called the dividend discount model, takes a company's historical cash flows, makes adjustment to those cash flows for unique or one-time occurring items, and then says, well, history is a proxy for the future. And then it converts these cash flows to a value using the Gordon growth model. And we'll review that in class. And again, this converts the company's historical cash flows, which are deemed to be a proxy for the future cash flows, into a value. So both of these methods are using what they're called income approaches, but really we're taking the company's income statement and then converting that net income into a cash flow. And we'll discuss that in class as well. How do you convert net income into cash flow? The second method or approach is called the market approach. And the market approach just means, hey, if we're trying to determine the value of something, we want to look at any sort of items that are similar to ours that have sold or are selling currently. And we can use those sales as a proxy for what the value of our asset would be. So the way this works from a privately held company standpoint is we can look in the publicly traded markets. We can look on the NASDAQ. We can look on the New York Stock Exchange for publicly traded companies that are similar to the subject company we are valuing in our valuation. So for instance, if I had a coffee company, a coffee business, I might look and see, well, how is Starbucks being valued? What is its multiple to net income? What is its multiple to other profitability measures like EBIT and EBITDA? And we'll discuss what those are in class and actually use this method. So what we're doing is we're using publicly traded company data on value, and we're combining that value with some accounting measures to determine a proxy multiple or a proxy value that we can apply to our company. We can also do this using merger and acquisition data. So if a company has been acquired by another, then that acquisition price might give us some indicators of value. So for instance, if one company purchased another company that was in the coffee industry, then we have an acquisition, and we know what the purchase price was for that, and we know some accounting data for the company that was acquired, and we can often come up with some multiples. So this uses comparable transactional data, mergers and acquisition data, to come up with a value for our privately held business. So again, comparable companies trade in the public market right now. Comparable transactions mean a company similar to ours was acquired by another company and created a valuation. Another set of approaches are called asset approaches. And this will take us back to Accounting 101, where you learned the accounting equation. So let's talk about what these methods do and then how the accounting equation gets used. If you think about a company's balance sheet, it's a listing of its assets, liabilities, and equity. And we have our good old accounting equation, assets equals liabilities plus equity. Now, the assets as recorded on a company's balance sheet are recorded under the accounting rules. So when we acquire an asset, we usually record that asset at its historical cost. So if we buy land, buildings, vehicles, equipment, we record those at historical cost, and then we depreciate them to account for the wear and tear of those assets. Now, one way you can look at a company's equity, you take that accounting equation and use algebra to rearrange it to come up with assets minus liabilities equals equity. And equity is just another name for net worth or value. So under the adjusted book value method, you take a look at a company's assets and you mark those assets to their current market value from their accounting cost or whatever their depreciated value was. And you don't do this only for fixed assets, you do this for all assets. But if you think about a company's assets, you have things like cash, accounts receivable, inventory. Cash, there's no markup. Cash is what it is. Accounts receivable, you have to make sure that they're fully collectible, but if a certain percentage of accounts receivable may not be collectible, you should write accounts receivable down to its market value. What do you think you can actually collect? Same thing with inventory. You mark that to what you think the value of that inventory is. And then for land, building, equipment, you would want to come up with a way to estimate the value of those assets and mark those to their market values. Then you look at the liabilities and you see if those are listed at market values, and generally they are. Sometimes with debt that trades like bonds, they're not at market value, but you take the assets minus the liabilities, and what you have left over is the equity or net worth of the company. One key difference between the adjusted book value and the second method, the net asset value, is that adjusted book value does not take into account any transaction costs. So if I was determining the value of a company based on marking its assets to market value, the only way I can really realize the value of those assets would be by selling them. And some assets like land and equipment might have a sales commission associated with that, land and really real estate in general. The adjusted net asset value does the exact same thing as ABV. It looks at the assets of the company, marks those assets to their market values, looks at the liabilities of the company and marks those to their market values, then subtracts assets minus liabilities to get to equity or net worth or value. But the net asset value method also considers transaction costs. So if we had land worth $1 million and there was going to be a 6% commission on that, we would take that land, reduce that $1 million by 6% to reflect what we'd have to pay to sell the land, and we'd have a net value of $940,000. That's our million less 6%. So really that's the only difference between the adjusted book value and the net asset value. So let's talk about the cost of capital. Again, this goes back to our income approaches. And when we discount a future cash flow back to present value, or we convert a cash flow via the capitalization method into a value, we have to make sure we're doing something. We have to match the cash flow that we've determined to the cost of capital. So for instance, and we'll talk about this more in detail, if our cash flow is cash flow to equity holders of a company only, meaning only to the common and preferred stockholders, then we want to have a cost of capital that reflects the risk of a common or preferred stockholder. If we have cash flow to all invested capital, which means we have a cash flow that would be going to both the debt holders and the equity holders, then we would want to use what's called a weighted average cost of capital, commonly referred to as a WACC, W-A-C-C, to determine the company's enterprise value, which is the value of both its debt and equity. Then we would subtract debt to determine the equity value. So in other words, that second method looks at the company as a collection of two different forms of capital, debt plus equity, comes up with a value called an enterprise value, which takes into account both of those, then subtracts off debt to get to the equity value. And some firms subtract off net debt, which is debt minus cash, and we'll discuss that more when we get into class. We'll also go through a few examples of this in class about how to determine cash flow to equity, how to determine cash flow to all invested capital, and then we'll go through ways of coming up with values and making sure we're deriving the equity value for our privately held business. There's also something called levels of value, and that'll come up in a separate lesson. But when we use market comparables, in other words, publicly traded companies that currently trade in a stock market, those companies are what's called a marketable minority interest level of trading. Marketable means there's full liquidity. It takes 2 to 3 days to turn when you sell that stock, to turn it into cash. And minority interest is another way of saying non-control, that the shares that trade in the publicly traded market are all small blocks of stock. It's not like a 50% interest is trading. You have maybe 100 shares trading or 1,000. So very, very small percentages. When you use the M&A method, that second market method, what's sold is generally the whole company. So one whole company is sold to another. Now there are exceptions to this. Sometimes a non-controlling interest is sold, or usually it's a remainder interest, like 50% was sold and now the other 50% is going, or 80% was sold and this is the last 20%. But when a company, control of a company is sold, that means your valuation is on a controlling basis, 100% was sold, and a fully marketable basis because that company was out there in the market and acquired by another company. Now, what if a company that's privately held sold some of its own stock? Well, this is a non-marketable, non-controlling, or minority interest stock interest. So we know that privately held companies do not have liquidity, and if it's less than 50%, that would be a non-controlling or minority common stock interest. You always have to ask yourself, is a transaction arm's length, meaning is it the kind of deal between two unrelated parties? And we'll talk more about that in class, why that's important. Okay, that is our lesson on the 3 different approaches to valuation. Hope you found that useful.